Before we begin, take a breath and listen carefully, because what you're about to hear could completely change how you see the silver market. Imagine waking up to find that one of the world's most powerful banks has quietly sent an internal warning telling its biggest clients to get out now, not next month, not next year, but immediately, while the public is still distracted. A leaked Morgan Stanley memo, allegedly sent just minutes ago, is circulating behind closed doors, and if it's real, it raises one terrifying question for anyone holding silver today. Do the smartest institutions already know something you don't? Let's slow this down and unpack it properly, because panic helps no one, but understanding does. Silver has always been a strange metal, living a double life. On one hand, it's a precious metal, a store of value that has been used as money for thousands of years. On the other, it's an industrial metal, deeply embedded in solar panels, electronics, medical equipment, and electric vehicles. That dual role makes silver uniquely volatile. When economies grow, industrial demand pushes prices up. When fear rises, investors rush in looking for safety. But when something breaks in the middle of that balance, silver doesn't gently adjust, it snaps. And that's why a leaked memo telling clients to exit all silver positions is such a big deal. Morgan Stanley is not a YouTube commentator chasing clicks. Beer. It's a global financial institution with trillions of dollars under management, deep ties to governments, central banks, and the largest hedge funds on earth. When banks like this issue internal memos, they are usually conservative, carefully worded, and designed to manage risk quietly, not spark headlines. These notes are not meant for retail investors scrolling on their phones. They are meant for portfolio managers overseeing billions. So if such a memo exists, even hypothetically, the real story isn't the words themselves, it's why now. To understand that, we need context. Over the past few years, silver has been trapped in what looks like a frustrating range. It spikes on inflation fears, then collapses when the dollar strengthens. It rallies on green energy narratives, then sells off when industrial demand weakens. Many investors have held silver with conviction, believing that massive government debt, money printing, and currency debasement would eventually send it exploding higher, maybe even outperforming gold. That belief didn't come from nowhere. Historically, during periods of monetary instability, silver has often lagged at first and then surged violently. In the 1970s, silver went from under $2 an ounce to nearly $50. In 2011, it rocketed from around $9 to almost $49 in less than 3 years. Those moves created a generation of believers. But here's the uncomfortable truth most silver bulls don't like to hear. Every historic silver spike was followed by a brutal collapse. After 1980, silver lost over 90% of its value in real terms. After 2011, it fell more than 70%. Silver doesn't drift down slowly. It crashes when liquidity dries up. And liquidity is the key word here. Right now, global liquidity is tightening, not loosening. Central banks are not flooding markets with free money the way they did after 2008 or during 2020. Interest rates, even if they pause or slightly decline, are still historically high relative to the last decade. High rates strengthen the dollar, raise the opportunity cost of holding non-yielding assets like silver, and pressure leverage players. This is where institutions think very differently from retail investors. When you buy silver coins or ETFs, you're thinking in terms of value, protection, maybe even ideology. When a bank looks at silver, it sees margin requirements, futures positioning, counterparty risk, and liquidity stress. If too many leveraged players are on one side of a trade, it becomes dangerous. According to recent commitment of traders' data, speculative positioning in silver futures has been heavily skewed at times, with large funds holding significant long exposure. That means a lot of players are betting on higher prices using borrowed money. When prices start to fall, even a little, margin calls kick in. Those forced sellers don't sell because they want to, they sell because they have to. Now add another layer. Industrial demand for silver is not immune to economic slowdowns. Yes, solar panels use silver, but manufacturers are actively reducing silver content per panel to cut costs. Electronics demand fluctuates with consumer spending. Electric vehicle growth is real, but it is not infinite, and it is sensitive to subsidies and interest rates. If global growth slows, industrial demand expectations can drop fast. Banks model this relentlessly. They don't just ask whether silver is useful, they ask whether demand growth will justify current prices under tighter financial conditions. So when people hear exit all silver positions, they often imagine some secret discovery like silver being replaced overnight or a massive hidden supply. In reality, it's usually more boring and more dangerous. It's about risk. It's about the possibility that silver, sitting at the crossroads of precious metal and industrial commodity, could be hit from both sides at once. Falling industrial demand on one side and falling investor appetite on the other. When that happens, correlations break. Silver stops acting like gold and starts acting like a leveraged industrial metal in a downturn. Let's talk briefly about paper silver versus physical silver because this is where confusion explodes. Most institutional exposure to silver is not stacks of bars in a vault. It's futures contracts, options, ETFs, and swaps. These instruments are sensitive to volatility and funding costs. If volatility spikes or funding tightens, exiting becomes a priority. Physical silver holders don't face margin calls, but the price they see on their screen is still set by paper markets. When large players exit paper positions, the price drops, even if no physical silver changes hands. That disconnect can shock retail investors who believe physical demand alone sets the price. There's also the broader macro picture. Governments are drowning in debt, yes, but that doesn't automatically mean precious metals go up in a straight line. In the short to medium term, debt stress often leads to deflationary shocks, not inflationary booms. Assets get sold to raise cash. We saw this in March 2020, when silver collapsed from around $18 to nearly $12 in days, even as fear was peaking. It only rebounded later when liquidity returned. Institutions remember this vividly. If they suspect another liquidity event is coming, reducing exposure to volatile assets like silver makes sense. Now, here's the most important part, and this is where you need to think critically instead of emotionally. A leaked memo, even if authentic, does not mean silver is dead forever. It does not mean silver has no future or no role in a portfolio. It means that, at this moment, risk models may be flashing red. Institutions move early, often months before the narrative becomes obvious. By the time headlines scream crash, they are usually already out. That's why such leaks cause fear, because they hint at moves already underway. So ask yourself a simple question. Are you holding silver because why? You understand the risks and time horizon, or because you're emotionally attached to a story? Stories can be powerful, but markets punish blind faith. Silver can be a long-term hedge against currency debasement, but in the short term, it can behave like a falling knife if conditions align against it. Understanding that difference is what separates disciplined investors from shocked ones. As we move forward, we need to dig deeper into what exactly might be driving this warning, how silver compares to gold in this environment, and whether exiting means selling everything or simply adjusting strategy. Because the real danger isn't selling too early or too late, it's not knowing why you're doing either, because once you understand the why, the fear starts to fade and clarity takes its place. The first thing we need to examine is how silver is behaving relative to gold right now, because institutions rarely look at silver in isolation. They look at ratios, correlations, and divergences. One of the most important metrics here is the gold to silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 65% over long periods. During moments of stress, that ratio blows out. In 2008, it surged above 80%. In March 2020, it briefly touched 120, an extreme level that signaled panic selling in silver. When that ratio rises sharply, it tells you that silver is underperforming gold, meaning investors are choosing the safer metal and abandoning the more volatile one. In recent months, that ratio has been creeping higher again, even during periods when both metals appeared stable on the surface. That kind of quiet divergence is exactly the sort of thing institutional risk desks watch obsessively. To them, it suggests that beneath the calm, silver is losing relative strength. Gold is being treated as a monetary hedge, while silver is being treated as a risk asset. If you're running a large portfolio and you see that shift beginning, you don't wait for confirmation on the evening news. You act early. Another piece of the puzzle is the futures market structure itself. Silver futures trade on leverage, meaning a relatively small amount of capital controls a large amount of metal exposure. This amplifies gains, but it also magnifies losses. When volatility rises or liquidity tightens, exchanges can raise margin requirements. That forces traders to post more cash to hold the same position. If they can't or won't, they liquidate. This is how selling cascades begin. It's not that everyone suddenly decides silver is worthless. It's that the rules of the game change mid-play, and weaker players are pushed out. We've seen early signs of this before. Open interest, which measures the total number of outstanding futures contracts, often peaks near tops in contracts sharply during sell-offs. When open interest falls alongside falling prices, it's a sign of liquidation, not just new selling. Institutions know this pattern well. If internal data suggests that leveraged long positions are crowded and vulnerable, a preemptive exit becomes a rational move. Now let's zoom out to the macroeconomic backdrop, because this is where things get uncomfortable for silver holders. The global economy is slowing, but not collapsing, which is actually the worst possible environment for silver in the short term. In a booming economy, industrial demand supports silver. In a full-blown crisis with massive stimulus, monetary demand eventually takes over. But in a slow grind with high interest rates and cautious central banks, silver gets squeezed. Industrial users cut orders. Investors prefer cash or yield-bearing assets. The dollar stays strong. This middle ground is where silver often struggles the most. Speaking of the dollar, we cannot ignore its role. Silver is priced in dollars globally. When the dollar strengthens, it takes fewer dollars to buy the same ounce of silver, all else being equal. Even if inflation exists in the real economy, financial markets can experience disinflation or deflation. Right now, many institutional models show continued dollar resilience, driven by relative interest rate differentials and capital flows into U.S. assets. A strong dollar is a headwind for all commodities, but especially for those without yield, like silver. There's also the bond market to consider. Rising or even stable high yields compete directly with precious metals. If you can earn a real return holding government bonds or high-grade corporate debt, the incentive to hold silver purely as a store of value diminishes. This doesn't mean metals lose their long-term appeal, but it does mean capital rotates away from them when yields look attractive. Institutions constantly rebalance based on these relative returns. Retail investors often don't, which creates painful disconnects. Another factor that rarely gets discussed openly is inventory visibility. While physical silver shortages make headlines from time to time, large institutions have a different view of supply. They look at warehouse stocks, lease rates, and delivery data across multiple exchanges. Even a small increase in available inventory or a decline in delivery demand can change risk calculations. If internal data suggests that supply pressures are easing, even temporarily, it weakens the bullish case in the near term. Now let's address the emotional core of this issue, because this is where many investors get stuck. Silver attracts people who distrust the financial system, and often for good reason. Fiat currencies lose purchasing power over time. Governments overspend. Central banks manipulate rates. Silver feels honest, tangible, and finite. That emotional anchor makes it hard to accept bearish arguments, especially when they come from big banks, that many people already distrust. But markets don't care about trust or distrust. They care about flows, leverage, and timing. Institutions are not saying silver has no value. They are saying that at this moment the risk-reward balance may be unfavorable. That's a subtle but critical distinction. Exiting a position does not mean rejecting the asset forever. It means stepping aside until conditions improve. Think of it like leaving a crowded theater not because the building is worthless, but because you smell smoke and exits are narrow. This brings us to strategy, which is the part almost no viral headline explains. Exiting all silver positions does not necessarily mean dumping physical metal at any price. For institutions, it often means reducing or eliminating leveraged exposure, trimming ETFs, closing futures, and lowering overall portfolio sensitivity. For individual investors, it could mean reassessing position size, time horizon, and purpose. Are you trading silver, or are you holding it as insurance? Those are very different things, and confusing them leads to bad decisions. If silver drops sharply due to forced liquidation, it can create future opportunity. The biggest silver rallies in history started after maximum pain, not during comfort. Institutions know this too. They exit on rising risk and re-enter on washed-out conditions. That cycle is brutal for anyone who rides the entire move without a plan. So when you hear about a leaked memo urging an exit, don't just ask whether it's true. Ask what conditions would make such advice logical. Tight liquidity, high leverage, weakening industrial signals, a strong dollar, and fragile sentiment all point to one thing: vulnerability. Not certainty, but vulnerability. And in markets, vulnerability is often enough to trigger sharp moves. Under increasing pressure from both markets and headlines, this is where understanding flow dynamics and relative positioning becomes crucial. When large institutions reduce exposure to silver, they don't just vanish from the market, they reallocate. Some capital moves into gold, some into cash, some into other commodities or safe haven assets. This rotation can temporarily depress silver prices even further, but it often creates a divergence between silver and gold. For example, in late 2015, Gold remained relatively stable while silver tumbled, creating a historic spike in the gold-to-silver ratio. Observing these patterns allows disciplined investors to anticipate potential opportunities rather than react blindly to fear-driven selling. Another critical piece to examine is sentiment, which in commodities markets can be as influential as fundamentals. The commitment of traders' report, social media chatter, ETF flows, and even Google search trends all provide clues about market psychology. When sentiment becomes overwhelmingly bearish, it often coincides with institutional exits, not because fundamentals have shifted dramatically, but because crowd psychology has reached extremes. Retail investors, who tend to be the most emotionally reactive, are often the last to sell, meaning the market can overshoot on downside before stabilizing. Let's dive into physical versus paper silver again, because this distinction is more important now than ever. Physical silver has constraints. It must be mined, refined, and transported. Paper silver, futures, ETFs, and derivatives can be created or unwound almost instantly. A sharp exit by institutional players usually impacts paper markets first, causing prices to drop rapidly. Physical demand might remain stable, but its effect on pricing lags behind. This creates both risk and opportunity. For the individual who owns physical silver and can withstand temporary price swings, this is not necessarily catastrophic. For those holding paper contracts or leveraged ETFs, it can be devastating if they are caught on the wrong side of margin calls. Historically, these kinds of corrections in silver can be severe but short-lived. Consider 2008. Silver plummeted from around $20 to under $10 within months during a liquidity crisis. But by 2011, it soared to nearly $50. The lesson is clear. Timing and understanding context matter far more than panic-driven action. Institutional exits are part of the cycle, not the end of silver's story. Recognizing this distinction helps investors navigate volatility intelligently rather than emotionally. We also need to consider the macroeconomic backdrop again, particularly interest rates and inflation. Central banks have tightened policy globally, and real yields are turning positive in many jurisdictions. This increases the opportunity cost of holding non-yielding assets like silver. When yields rise, investors often rotate away from precious metals into fixed income instruments that provide income. However, inflation remains sticky in certain sectors, and silver still retains value as a hedge. This duality creates a complex environment where silver can underperform in the short term, while remaining strategically important for long-term wealth preservation. Another angle is technological substitution. Silver is critical in photovoltaics, electronics, and EV batteries, but incremental efficiency improvements and alternative materials can reduce industrial demand growth. Institutions model these trends carefully, assessing whether current prices already reflect future consumption. If not, reducing exposure is a rational risk management decision. In other words, a temporary oversupply or weaker demand projection can trigger exits without signaling a permanent downturn in silver's fundamental utility. Now, let's talk about risk management strategies that savvy investors can consider in this environment. One approach is scaling out. Instead of selling everything at once, reduce exposure gradually while monitoring market signals. Another is diversification. Balancing silver with gold, platinum, or even cash positions can mitigate volatility. For long-term holders, maintaining a core allocation to physical silver, outside of leveraged instruments, preserves exposure without excessive risk. The key is clarity on objectives. Trading for short-term gains is different from hedging against systemic risk. It's also worth noting that external shocks, geopolitical tensions, or unexpected supply disruptions can quickly reverse sentiment. Silver is sensitive to crisis events. War, energy shocks, or new industrial booms can trigger sudden spikes. Institutions understand this too. They may exit positions not because silver is fundamentally flawed, but because near-term risk outweighs potential reward. Timing re-entry is as important as timing exits, and those who can observe the flow without panic often benefit the most. Finally, let's touch on communication and misinformation. Leaked memos, rumors, and social media posts can distort perception. Not every exit alert reflects reality or immediate market moves. Institutions often issue internal guidance for prudence, not panic. The leak itself is a sign of the modern information age, where markets react to perception as much as reality. Retail investors must filter emotion from analysis, focusing on data such as futures positioning, ETF flows, and industrial demand, rather than headlines alone. So, where does this leave us? It leaves us with perspective. Silver is vulnerable in the short term due to leverage, liquidity, and macro pressures, but it retains strategic value for long-term portfolios. Institutional exits, if confirmed, signal risk management, not apocalypse. Savvy investors can use this environment to reassess positions, understand market mechanics, and plan for both short-term volatility and long-term opportunity. Patience, research, and a disciplined approach remain the strongest tools in navigating this complex market. In conclusion, the leaked Morgan Stanley memo urging an exit from silver positions serves as a stark reminder of the complex forces driving this market. Silver is caught at the intersection of industrial demand, monetary hedge appeal, and leveraged speculation, making it uniquely sensitive to liquidity shifts, macroeconomic pressures, and investor sentiment. Institutional exits do not signal the death of silver. They signal risk management in a volatile environment where high leverage, strong dollar strength, and tightening monetary conditions create vulnerability. Thank you for individual investors. The key takeaways are clear. Understand the distinction between paper and physical silver. Differentiate between short-term market noise and long-term value. And align your strategy with your objectives, whether that's trading, hedging, or preserving wealth. By focusing on fundamentals, monitoring flows and ratios, and maintaining disciplined risk management, investors can navigate turbulent periods while positioning themselves to benefit when silver's strategic role reasserts itself in the broader financial landscape.